Get more on the ETF landscape and specifically the fixed income space. Apparently Aussies have generally had one of the lowest allocations to fixed income compared to global peers. To tell us why fixed income ETFs have been a game changer for investors and are gaining popularity now, Marc Jocum from Global X ETF joins me up on the desk. So what are we seeing?
Yeah, like you said, for a conservative nation like Australia, you would expect us to have a higher allocation towards fixed income, but we really don't. If you look at the broad allocation amongst Australian investors around superannuation funds, we have around about a 14% allocation to fixed income, which has been pretty much the same for the last 10 years.
Yeah.
And if you compare it to some of our global peers, they're closer to 30, 40 or 50%. So you might ask, like, why? Why is that the case? And one of the reasons has been really around accessibility to fixed income. And that's where ETFs have really changed the game, I feel. If you look at the fixed income landscape within the ETF world, they've only been around since 2012, but they're already worth around about $28 billion in terms of assets. Now that only accounts for around about 14% of the total ETF market, but that's about double what it was 10 years ago. And you're consistently seeing more product innovation, more flows going into fixed income ETFs. There's now over 70 ETFs to choose from. And last year was a really interesting year, speaking of flows, where fixed income ETFs pretty much equated equity flow ETFs, which doesn't normally happen. This year, a little bit different, more risk on, more into equities, but fixed income is seeing a lot of popularity.
And as you say, 2012 was when some of these were launched, but also the return is at those levels now too.
Yeah, I feel like for a lot of bond investors, they have felt, I guess, a little bit of a tough time with the last couple of years. Rising interest rates has led to a lot of fixed rate bond prices declining, but now income is really back. And that's where you're seeing yields that you haven't been able to achieve for, like you said, the last 10 years. And that's what's making fixed income a lot more attractive, particularly around the broader areas of fixed income. Traditionally, investors were exposed to government bonds, and now there's more around corporate bonds, subordinated bonds, inflation bonds. There's a whole plethora of ETFs and asset classes that people can get access to.
With the fact that we don't know whether the RBA is going to hold, hike or potentially cut later in the year, how do you sort of protect against or get some protection, I guess, then in the fixed income space?
It's a great question. And I think investors try to predict what is going to happen with the RBA, but the best thing to do is to prepare. And that's by having a diversified mix of different fixed income asset classes, which can preserve its capital. It has capital preservation characteristics, but also the yield profile is quite interesting, because if the RBA does decide to actually hike interest rates, having exposure to floating rate notes or floating rate bonds can really mimic the returns that you're seeing in some of the benchmark series like the bank bill swap rate or the RBA cash rate. So that's where investors can really position themselves to protect from interest rate rises. Overall, we don't know what the RBA is going to do. Michelle Bullock yesterday pretty much said that the aggregate demand and supply wasn't where it needs to be in terms of equilibrium. There is that, lag that normally happens with monetary policy, but all eyes are pretty much going to be on the inflation print next week. And I have a feeling that if we don't see something with a 3 handle in front of it, there could be cause for potentially the RBA to consider either keeping rates steady or potentially hiking, and we'd be one of the only nations in that position alongside Japan, whereas the rest of the global central banks are in this easing phase, like we saw the ECB, Switzerland, Canada, and even the US towards the back end of the year.
Yeah, and then of course that then plays to how do you find exposure to that. The banking stock's looking kind of good, but what are you seeing in terms of getting exposure to banking credit?
Yeah, and a lot of Aussies tend to, we do have an obsession with the banks. It's a huge part of our market, but we tend to invest in banking shares or within the term deposits. And within term deposits, you can get yields of around about 4.5%. But if you look at the broader capital structure of a bank, so you've got your deposits at the top and then your shares at the bottom, there's this nice layer in between. We can get access to senior bonds, subordinated bonds, and hybrid securities that really provides that yield enhancement that clients can get. And when you're looking at the yield of some of the bigger banks, the yields are now trading below some of their the yields you can get on some of the senior bonds. So investors really need to ask themselves, why am I accepting a higher risk for a skinnier return profile? And when you look at some of the banks, they're now trading, CBA just reached record prices, being the most valuable company in Australia, but its yield has fallen.
Yeah.
And overall yields have compressed within the broader ASX 200. So that's where we're seeing a lot of investors looking to position their portfolios to get enhanced yields through things like banking credit, considering that Australian banks are some of the strongest in the world.
So the ETF here, there's always an ETF for everything.
There is an ETF for everything. We're very proud to launch our brand new ETF today, the Global X Australia Banking Credit ETF. The ticker code for that is BANK.
Oh, that's nice.
Very simple ticker, very simple product. What I really like about this product, it's a first to market solution that really provides investors that diversified mix of the capital structure within a bank. So you're talking about getting exposure to senior bonds, subordinated bonds, and hybrid securities in one very easy, low-cost index fund. And what I like about this fund is it's targeting monthly income, so that's really important for investors. It's got about a running yield of around about 6%, and it also benefits from having hybrids in the portfolio, so investors can get franking credits with that as well. So instead of deciding, how much do I want in senior bonds, subordinated bonds, how much do I want to be in floating versus fixed, where do I want to take duration plays, sometimes it just makes sense to tune the noise out and actually outsource that to a very low cost fund. We're charging 0.25%, which is really, really competitive, and providing that income enhancement and defensive capabilities that clients are looking for in their portfolios, particularly now that fixed income is really back.
All right, I can't let you go without asking your thought on the Ether ETF launch in the US overnight. I mean, I was talking earlier to Igor Sedelska and said, is this disappointing given only 1 billion changed hands compared to 4.66 for Bitcoin? But he said, no, it's not Bitcoin, so it's actually quite impressive.
Totally different. So when you're looking at the broader cryptocurrency ecosystem, Bitcoin is definitely a bigger size in terms of the market cap of it. Ethereum's a lot smaller, and a lot of analysts only predicted around about $300 to $500 million to trade within it. So I actually think the fact that Ethereum ETFs had around about a quarter of the Bitcoin success, and Ethereum is still a technology that people are exploring with. A lot of Bitcoin's a bit more well known in terms of the widestream media, is particularly around financial advisors as well. I think it's actually a great result. And we're obviously lucky that we have an ETF here already, so we're already a couple years ahead of the curve with it. But I see continuing growing adoption of cryptocurrencies, particularly with ETFs. And we've actually seen the interesting thing within the US is it's actually been widespread across multiple ETFs. And we'll see that if more money piles into Ethereum ETFs, that unquestionably has an impact on Ethereum prices as well, as we saw what happened with Bitcoin too.
Yeah.
So will it be the same level of success? Not 100% sure, but first day, over $1 billion traded, that's success to me.